Today on this episode of the Brain Surgeon's Take, we will be discussing investing in the current U.S. economy, opportunities and considerations, with counselor to the U.S. Treasury Secretary and Managing Director at BlackRock, Craig S. Phillips. Learn about strategic approaches for investors in the modern-day market, taking into consideration financial headwinds, political policy uncertainty, promising growth sectors, as well as booming technology and AI. Much more on this podcast episode. Welcome back, everyone. Here's my take on Craig Phillips. He knows the economic landscape inside and out. Craig is a seasoned financial strategist and investment advisor with decades of experience guiding portfolios through changing market cycles. He's advised both institutional and individual investors, helping them navigate everything from bull markets to economic uncertainty. Today, Craig will share his insights on how investors can position themselves amid high interest rates, shifting inflation dynamics, and evolving global trade pressures. We'll explore where he sees potential growth, whether in equities, fixed income, real estate, or emerging sectors, and what considerations should be top of the mind for anyone looking to build or rebalance their portfolio in 2025 and beyond. You will love this interview. We break down the biggest trends shaping markets, money, and the future of investing. Most importantly, we dive into one of the most pressing questions on investors' minds. Where are the smart opportunities in today's U.S. economy, and what risks should we be watching for? This conversation will give you a clearer, more confident perspective on this topic. Listen up as we discuss investing in the current U.S. economy, opportunities and considerations. Check it out. Hey, Craig, how are you?
Just fine, Rick. Good to see you.
Listen, very excited to have you on the podcast today, and kudos to my colleague, Greg Basil, for setting up this important interview. As background, recently there's a lot of talk about bubbles in global markets, whether it's AI, cryptocurrency, housing markets, and even the stock market. And although no one can really predict the future, you have a ton of experience in these financial markets, both on Wall Street and in the U.S. Treasury. As background, you were also essential in our recovery following the financial crisis of 2008, when your group was named the Masters of Disaster. So I want to take your knowledge, take your experience, and discuss investment recommendations in these times, which are uncertain. Whether you invest too much, it's too risky and you blow up your investments, or you're not risky enough and then you don't have a nest egg. So a lot of questions, a lot of uncertainty, and look forward to your expertise, Craig.
Great. I'm looking forward to it.
Well, I guess let's start just by leveling out and seeing what exactly is a market bubble. We use that term all the time, but how is it created? How does it burst? And what is the typical fallout?
Sure. Well, first of all, as a disclosure to everyone, I'm not predicting a crash or a market correction. What I'm going to try to do today is set the tone of why those corrections happen, and perhaps why listeners might, in thinking about their own personal investments, better manage their risk around that as a almost inevitable outcome at some point in their investment history. Right now, you hear a lot about the AI bubble. Is AI a bubble? And what that really means generally is that has too much money applied into that trade and inflated it beyond the potential of the AI innovation itself. So I think of sort of a bubble most like a balloon, and there's kind of two different types of bubbles that unfold. The balloon represents containing a trade that is valued a certain way, and it getting bigger means the valuation is growing and growing. One outcome is it just keeps growing until the balloon naturally explodes. It exceeds the capacity of that balloon and it explodes. The other mechanism is the balloon gets bigger and bigger and bigger, but it's pricked with a pin. And so an exogenous variable triggers the release of the air. The outcome's the same in both cases, but kind of different paths. So a financial bubble is when a asset class or a particular stock or some element of the economy gets in a bubble, it gets inflated beyond its potential and either bursts normally due to market size or an exogenous event. Frequently, you talk about things like irrational exuberance, that irrational exuberance goes overboard and blows the bubble. Leverage, people have borrowed money to invest money, or just a flawed financial product. So today we'll kind of explore different characteristics, but a bubble is a trend that gets overextended, blows up, and then usually corrects to a pricing and valuation way below the peak that it experienced.
Now, sometimes during a financial panic, after a bubble crashes, are there actual villains and perpetrators? Are there people who benefit from these crashes?
It's interesting. The regulators, the press, victims always want to put a face of evil on this. Bernie Madoff and a failure of one hedge fund through fraud would be an example where a bubble did have a perpetrator, and frequently that is tied in with fraud, which is usually not the major driver of a bubble. Usually, what you have is greed at the cornerstone. And usually it starts by something that is a good idea. There's a good idea that is undervalued. And then the perpetrators are people who sell investments, people who own the asset, and they start to promote this good idea. And the greed factor really results not in them being the perpetrator, but them just willing to stop when they should stop. So middlemen get involved. There's a food chain of value being created, and everyone wants to wait for just that one last quarter, the last earnings call, and they just keep pushing it and pushing it and pushing it. Those people frequently then start to integrate people in the trade that are less sophisticated. So certain things start by very sophisticated hedge funds in a trade. And by the end of the cycle, it's retail investors that are less familiar. And sometimes those investors can be taking out the original investors and monetizing profits. But my experience has been that the people that usually perpetrate it end up being involved when it blows up. So they actually are victims themselves. And while institutions' reputations tarnished, there's maybe institutional failure, there's lawsuits, that there really isn't a clear perpetrator that benefits. Around the edges, you might have someone who starts short selling. But again, I wouldn't call them a perpetrator, I'd call them a participant in it. So this whole
Gotcha.
idea that there's evil and someone manages this, my experience has been the opposite. Usually the people in the middle of it get hurt just as bad as other victims when it blows up.
Now, what about legislation and regulations? There was a lot of new ones placed after the 2008 financial crisis. Is our system more sound now than it was before?
Yeah, sure. 2008, which was really about originally subprime mortgages and sort of overextended home buyers, um, was in the backdrop of a fairly antiquated regulatory system. Banks did not have adequate capital. Um, the big banks have become a very large percentage of the banking system. They, in particular, as systemically important institutions, weren't capitalized inordinately compared to smaller banks. Um, Market regulation, clearing of securities, collateralization of forward trades and derivatives, all were things that were kind of missing in a system that had become much more sophisticated and much more globally interconnected. So after the '08 crisis, there was a massive piece of legislation called Dodd-Frank, which really introduced an entirely new framework for capital standards for banks, for market clearing of securities and derivatives, so market structure, think of the New York Stock Exchange and other clearing corporations, and sort of the notion that the world is global. So when a large financial institution fails, Bank of America is not just in America, it would have subsidiaries all over the world, and vice versa for a Spanish or a British institution operating here. So they really contemplated global resolution of financial institutions. So where I sit, the system is entirely better managed from a regulatory point of view, and that the failure of institution is less likely to be the cause of the triggering of financial crisis today. Is it perfect? No. Trump 47 is in the process of easing some of those regulatory restrictions that were created. This in part is good, but could lead to other consequences. And ironically, the U.S. system is tighter than the rest of the world. In '08, we were kind of looser than the rest of the world, and many complain that our standards are higher than the rest of the world and making us uncompetitive. But the bottom line to your question is we're in a much better place than we were on a regulatory basis. Now, the caveat to that is anytime you create a new regulatory structure, someone figures out how to do the activity outside of the structure. Cryptocurrency would be a good example of that, or private credit. Private credit or private funds lending versus getting a loan from a bank. So regulatory arbitrage, or what you might call shadow banking, is a persistent problem. And I would say my one caveat to my statement is that this tighter regulation has created more outlets of activities outside the regulatory framework, and those activities are in some ways no less secure than in '08. And it's that iteration that's hard for regulators to identify and manage on a real-time basis, and they tend to address it after there's a problem, not before a problem.
How does today's macroeconomic environment compare to the environments of prior crises like 2008?
Well, this will probably be cautionary and sound cautionary. I have a term that I use for my wall of worry. What are all the different things that could go wrong? And my chart is very high at the moment, okay? And my observation is the investing public is not reactive to triggers of factors that would normally trigger a market sell-off. So they become almost endurable in thinking that these problems won't catch up with them. So the wall of worry that I have now are really just a few very fundamental, simple things. The big things are usually simple. One is structurally higher interest rates. We've become convinced that interest rates at 0-2% are normal. Those are extremely abnormal. So the rate of interest we have now is likely to stay at this level or be higher over time, in my opinion. And I don't think that's really been factored in for the consumer and corporations, and particularly the government, borrowing at those rates. I think there's a hope factor that somehow rates will miraculously go down. The second is unsound levels of government debt. So this party has been extended by huge fiscal stimulation and massive deficits and a very, very enlarged Fed balance sheet. It first became enlarged in '08, but it's gotten bigger and bigger and bigger even through this recovery. So I think the sovereign side is overextended. Globalization is breaking down. So really the key to me of the prosperity in the economy over the last 20 years has been globalization, getting the best labor and the best products across border and moving them in to sort of have efficiency. Tech has also enabled that. Globalization is breaking down, and we have war and incredible tensions. And lastly, there's really a battle of the have and the have-nots. Sort of the wealthy have gotten wealthier, and there's really a struggle of poverty in our country and in the world. So the wall of worry to me is huge, and Trump bombs Iran. We put conflicts on Russia. Every day the market just ticks up and sort of is somewhat unresponsive to what I consider the worry. And here we have the government shutdown. So I think what I'm looking for is when are these factors that seem to be a concern kick in, and how does it adjust values? But the lack of adjustment value to these many risk factors I find remarkable at this point in the cycle.
I mean, just like you said, there's so many different stress points. And in your opinion, what is the biggest stress point that has the most leverage?
Well, leverage is a great term because usually when there's a big market correction, people always talk about leverage, right? So what leverage is borrowing. So some people may not understand what that means, and it means that you're buying an asset, but you're borrowing money to buy it. We all frequently buy houses and get a mortgage, but people actually buy investments and they borrow the money. The ultimate example of that are hedge funds. The hedge funds are leveraged vehicles. They actually have a certain amount of capital, but a hedge fund with $2 billion of capital might have a $12 billion position, and that money is lent to them by broker dealers and banks or prime brokers. So the simplest form is borrowing to invest, and the problem with that is that secured lending is based on the asset value. So if you own a stock and you've borrowed half the money and that stock price goes down, you get a margin call. That margin call means you have to put up more cash to support the loan because the value of the asset they lent against lent against has declined. Now, if you don't have that cash, what do you have to do? You have to sell the asset. And if you're in a crowded trade, everyone is selling the asset at the same time because they all have margin calls. So I think on that, the first level, we don't have extreme leverage in supporting markets, but we'll probably talk about the tech sector and Magnificent Seven, and some of the largest cap stocks. My guess is there's plenty of margin supporting that investment. But more fundamentally, away from sort of leveraging investments are the leverage of parts of the economy. So when you really think about the pieces of the economy, there's the consumer, there's corporations, there's particular sectors like commercial real estate, and there's the government itself, which in the U.S. is the federal government and the state government. The '08 crisis was really about consumers being over-leveraged, particularly on mortgages when housing prices started declining. Many recessions are based on corporations being over-levered. I would say the consumer and the corporation leverage is at normal conditions now. The most susceptible party to leverage is our government. Our government has become excessively over-leveraged, and it's really my biggest concern. Right now, our government debt is 125% of GDP. That means our debt's $37 trillion. Our gross domestic product is $30 trillion. That ratio is something that 20 years ago would have been viewed as unsound and equal to the leverage of an emerging market country. So we really are in overtime in terms of how we're managing our fiscal resources. And it's not just the government debt, it's also the Fed. The Federal Reserve, the central bank, which sort of really issues the currency and maintains bank reserves, has almost an $8 trillion balance sheet. Why? For examples, mortgage-backed securities issued by Fannie Mae and Freddie Mac, the Federal Reserve owns almost 30% of those securities. Now in '08, I helped the Federal Reserve buy those securities to stimulate and support the mortgage market. It never crossed my mind in 2025 that they would actually continue to keep reinvesting in these assets. So what you've had throughout the whole cycle since '08, for different reasons, COVID, certain sovereign scares and liquidity panics, tapering tantrums, et cetera, the Fed has just sort of kept growing its balance sheet. So think of the federal government as being the actual government spending money in a fiscal deficit and they have to borrow, and the Fed using its balance sheet. So that's honestly, Rick, my biggest concern is the government is overextended. And ironically, they're the ones that need to do bailouts when there's trouble. So it's actually the worst party to be extended.
How is technology impacting the way people invest? Is the younger generation more actively investing, and how does that impact generational wealth?
Yeah, I think it's really changed in the sense that social media and the existence of apps that allow you to make payments and do other things in your life are also entering the investment world. And to me, gamification is not realizing that clicking a button on your phone is a real life decision. And so I do worry that the way people are informed through social media and sort of the decay of actual media, the ability to be influenced quickly by trends and themes that are actually artificial, AI being a perfect example. You probably notice in your feeds now these comical videos of Donald Trump falling down or, a building blowing up. I mean, there's a financial version of that. Imagine a fake earnings call where someone announces something and actually it's completely fabricated and it's completely anonymous. No one knows who's actually released this weapon. So I do worry that the way people are making their investment decisions and the rapidity of information flow, people are sort of less sound in sort of how they're getting advice and how they're building their information. And they very quickly can sort of make a move. Cryptocurrency in its rise is probably the perfect example of this. It's not really promoted by anyone, but instantaneously everyone through a wallet can acquire this investment asset, which has grown in tremendous value. So I'd put that as Exhibit A, as something that outside of this tech environment and the way we communicate and transact couldn't have existed even 10 years ago. I think one of the real risks of this too is a false sense of liquidity. I'll give you an example. There are algorithmic programs that identify houses when they're listed instantly. There are buyers that buy them within 5 minutes without seeing them because they have an algorithm that's analyzing the value and they believe it's off market by their investment scheme. Some of these cash buyers don't have to get a mortgage, so they don't, take into account, getting approved for mortgage and a closing time. They'll close for cash immediately. And so all that sort of begs to suggest that housing prices are very liquid. Well, we've all had houses when the market is not liquid and, it's 270 days on the market, 365, et cetera. So I think part of the problem with this gamification is it gives a false sense of liquidity when times are good. And you have a lack of appreciation of how hard it is to sell certain assets when times are not good. And I think the real manifestation of are these meme stocks. We've all seen these epic moves in GameStop and other securities. Again, prior to this tech evolution, things like that would not have existed or been possible. The last thing I'll say, because you mentioned generational wealth, a bunch of young people are about to inherit a lot of wealth from the previous generation, trillions of dollars. Some of it's very concentrated among families, but in general, it's the last generation has experienced an incredible increase in wealth. So I do worry that this young generation and their proclivity towards technology will be inordinately correlated with them having a lot of new money. And I wonder, will they seek traditional advice or self-direct? And it's kind of unprecedented, this environment. I love technology. I love what it does in my personal life. It makes me a better investor, but it is a nuclear weapon, and the ease at which you can enter it is a bit alarming to me.
Now, you say that you're not sounding the alarms, you're not predicting a crash, but if everyone wants to know, what are the signals of an impending bubble burst? What would you say are some signals that we should all be looking out for when investing?
Well, I guess maybe a starting point would be to talk about why you're investing and who you are. So I think the most important thing of signals is a signal of volatility. So the real kind of answer before I'll answer that question is, what is your risk appetite and tolerance for risk in your holding period? So if you're a person who's 40 in your prime earning years, you're really trying to accumulate savings that you can grow. And if your scenario is correct, you can tolerate incredible change in those values because you'll just keep adding more money to that account and sort of be averaging in through the cycle. And if you're confident that you're not going to draw down that money, the only thing that matters is the price you acquired the asset and the price you eventually sell it. All the prices in between are just noise. So I think the first thing is to really make sure that you have the right orientation to risk appetite for the duration of the time that you're in the investment. And so volatility has two factors. One, do you have to sell the asset when it's down? But also there's an emotional volatility. Can you tolerate hanging on? And a lot of people think they can, but they just can't. They buy something, it goes up a lot. Then even then, when it goes down and gets back to their cost, they freak out and they sell it. And they certainly sell things when it's down 20 or 30% from when they bought it. So for an individual, staying power is not just financial, your ability to stay, it's also emotional. So I think the signals are, today in the economy are really driven by policymakers. We have a huge tension between our politics on the left and the right. Fringe theories have become norm. So I think watching to see how that plays out. And I think we are at the risk of huge swings going too far left, too far right. Right now, we're kind of swinging the one direction that could rapidly come back. So I think policy direction is something I'm looking at. Our war with the world is something I'm looking at. Do tariffs work? There's a little indication that they work in the scale we're proposing them. And what's that going to do our standing in the world? So really, we're at an epic cycle where the U.S. dominance of the economy, the world economy, is being ceded to a new axis led by China. And the U.S. is having a hard time tolerating that. So the reaction now is a war, but it's not clear to me that's a war that we can actually win. So that's, I guess, the second big factor is globalization. And the third one is just watching technology. I don't think AI is a bubble per se, but I do feel that if you look at the innovations of the last 20 years and what we've seen with Google and Meta and other companies like Microsoft, they've really changed our world. But my fear is that will keep going and that tech is actually a great investment theme to keep betting on. But I think there's got to be a lot of losers in the tracks of those winners. And I think AI, the biggest factor I have in thinking about it being a risk factor is not it not working, but what it does to job elimination and sort of wage pressure, the bargaining power someone has to get paid. And clearly, if someone doesn't adapt to using AI and other tools, they're going to become more and more obsolete. And our education system is perhaps not delivering enough technical education to our high school and college grads. So I guess I'm kind of looking at those factors that, the policy side, the global conflict, and sort of the evolution of technology, and sort of put that all together as sort of the tipping points. The one worry I also have is sort of the ultimate tipping point is cyber risk. We now are seeing a war in Ukraine that's being fought with drones. Okay, we could have a drone attack tomorrow in the United States. So someone has to just bring these things in and sort of launch them one day. They could do it over the years. It's similar to how the Israeli intelligence wired the pager phones in their opponent's camp. And so I really do worry about cyber risk underlying a lot of things too. I'm convinced the next financial panic might well be exogenous, a failure in a system, a technology breach, and maybe even an attack. So I guess my worries are kind of really around the government that's overextended, sort of having bad policies, us picking a war with the whole world, including our allies, and the tech path that sort of we live off of, sort of going to a whole new level of sort of causing damage to incumbent players that get sort of eliminated or greatly marginalized.
What about the banking system? I mean, we had a banking crisis just a few years ago. Are the banks in better shape now than they were back in 2008? And how do we compare to banks across the globe?
Yeah, so banks, most people understand banking generally, but a bank is just a warehouser of capital. You make a short-term deposit, and your deal with the bank is you can come get your money anytime you want. Well, banks don't have that cash sitting there. They invest it. They invest it in securities portfolio for liquidity purposes. And they put the money out in loans, which are much less liquid, and they have a much longer maturity. So banks really take credit risk with your money. You don't really have credit because your deposit's insured. They're investing in credit-sensitive instruments that might not pay back. And they're also doing maturity transformation. Your short-term deposit is being transformed on their side to a longer-term asset. So banks are always vulnerable in a crisis. In early 2023, we saw a panic with 3 banks failing. New York Community Bank, Signature Bank, and Silicon Valley Bank, a very large innovative institution. And all of them had a nexus with cryptocurrency and sort of concentration in the tech sector. So it truly was a meme panic where people thought, get your money out of the bank. So banks fail when there's bank runs or a failure to roll their liabilities, and it happened as recently as 2023. Those were some of the largest bank failures in history. And that kind of was just a blip that everyone said, okay, great, I'm glad that's behind us. And so it's an example of this wall of worry that's not being addressed. But having said that, I think the banking system is not the main source of our concern now. We're extremely well capitalized compared to all prior periods. And the US is more well capitalized than the rest of the world. And most of the regulatory easing that's occurring is on the non systemically important institutions, the smaller, less complex institutions. And in fact, with the big banks, they're not so much loosening, they're kind of stopping a tightening that was unfolding in the last administration. So it's kind of leaving it where it is, in my opinion. So I feel pretty good about the banking system. I do worry that they are being replaced by a new system, that people envision using cryptocurrency to make payments, that traditional financial institutions can be bypassed for lending and payments and other factors. So I think the world's changing, and perhaps the problem will not be banks, but bank-like activities that are creeping outside the banking system. And so I feel pretty good about the banking system and fairly confident that we won't wake up one day and sort of have banks with toxic assets, and that's what we're reading about is causing the next panic.
Now, you mentioned earlier appetite for volatility and the ups and downs of the market, which are always going to happen. What would you suggest to people listening to this podcast that are investing, and what level of risk should people be taking?
Yeah, well, it's a great question, and I guess you're a surgeon. I'm a financial person. We theoretically would have different perspectives on investing, but just because I've been a specialist in securitized products and derivatives and some fixed income doesn't make me a generalist investor either, and you probably are less so, with your technical background and probably how you spend your time. So the first thing I think is for people to know what they know, and to just like they wouldn't go perform brain surgery. Investing is like a form of brain surgery. You better work with people that know what they're doing. So I'd say that'd be my first observation. And then we all have fund money. So I think the other key to it is, well, how much of your saving is fund money? That might be for a second home. That might be buying NVIDIA stock or doubling down on your Tesla holding. But I think the other thing is just really what part of it is your fund money that you really can afford to lose? And ironically, sometimes that will be your source of your biggest financial gains, but it can't be everything. So I do worry that someone that has half their portfolio in Bitcoin is not really thinking about risk the right way, even though arguably it's been the single best investment in the world over the last 15 years. Someday that might change. So the fund money and knowing what that is key. And then the rest is really your duration of your holding period and when you feel you have to draw down assets. And as you get older, your risk profile should decrease. You should be more interested in fixed income and more interested in things with less credit risk. And your equity portfolio should start to represent a smaller piece of the puzzle. Now, retirees have faced a real challenge recently in this low rate environment. Investing in yield was earning a yield of almost zero. So the retiree of sort of the last 15 years has kind of burned off their savings more than they would have liked because of that low rate environment. So reality is reality. You might have to take more equity risk today because of the low rate environment and try to catch up. But someone who's in the later stage of their life, there's no catching up. It's one act, and it's a one path to work out. So I think the challenge is really balancing again your investment horizon, isolating your fund money so the real investment is separate from that, and working with professionals that can sort of analyze your situation. So a good compromise, even if you like to make stock picks and selections, is work with a financial advisor or a planner that can do a check-in once every 6 months. Be a reality check on how you're doing. Look at it against a longer-term plan. Look at it against your liabilities or life changes that might have happened. And I think that's probably the best check and balance, because I have a certain skepticism about financial experts, because just like the bubble, they're getting paid when they sell you something. And usually when they get you to invest in something that's riskier, they make more money than something that's simple. The yield to a financial advisor on selling a hedge fund is a lot better than selling you a T-bill, okay? So I think you have to look at their advice, even if it's good advice, through an independent prism, and really use a financial advisor. And then with that person, you can share your whole financial picture. So I wouldn't really recommend sharing your entire balance sheet with your broker at Merrill Lynch or Morgan Stanley, because really it's not their job. And two, what if you have 5 accounts? Do you want to share your entire picture with 5 different players? And I'd usually recommend having a diversity of advisors because different people are good at different things. But, have someone at the center that's a real financial planner that then is checking you out and saying, well, gee, you said you were doing this. Here's how it went for the last 6 months. Here's the attribution of like how your portfolio performed. And this one segment had a oversized gain or loss. And so I think that reality check that's independent of the financial investment decision is probably, for me personally, has been my best check and balance to kind of keep it real, but also keep it dynamic with the life changes that are really the factors you have to keep in mind that I wouldn't necessarily encourage to share with your financial advisor.
Now let's go crystal ball. I know you said you weren't predicting a crash, but when do you think the next bubble will burst, and what sector will that be in if you had to predict?
Well, look, I'll probably sound like Debbie Downer, but if this were a baseball game, I truly feel like we're in the 7th, top of the 7th or bottom of the 8th. And what I mean by that is the length of this business cycle is mind-bogglingly long. And my fear about it being long is it's largely been fueled by government spending and Fed balance sheet, which I consider to be at this point completely unsustainable. So just simply getting the balance back to budget neutral, a zero deficit, would be incredibly recessionary, because all of a sudden $2 trillion of budget deficit going in the economy becomes zero going in the economy. So even get back to normal is recessionary. And while I don't see that happening immediately, I do think the reality is setting in that we do not have infinite resources, and things like our credit rating and our standing as the reserve currency in the world is in question at this point. So that's kind of why I'm in the 7th and 8th inning. And I sort of see the factors that would keep us out of having a major turn in values and kind of a cycle is the hope that somehow interest rates will fall precipitously. And that's really my second risk factor is, we all read about Donald Trump and some of the things he's doing, but one of his activities is challenging the independence of the Federal Reserve. So usually the Federal Reserve is the cop that kind of runs the money supply, and their role is a dual mandate to keep inflation under 2% and keep the economy at full employment. Those two things are slightly at tension, but their mandate is to balance those things. If a politician actually had a say in that, like when you're in an election year, they would sort of say, well, that's out the window. Let's have interest rates fall. Let's be easy money. So the tension between the independence of the Fed is really critical. And the way the Fed is governed is there's a chairman, but there's a board of governors. And those board of governors are kind of bipartisan. They have very long terms, 16-year terms. So really they're appointed through the cycle of Democrats and Republicans. And so you really do have a bipartisan approach. And then the part of the Fed that sets interest rates is a committee. So it's the Open Market Committee. And that's comprised not just of the board, but select group of the presidents of the independent regional banks, the Fed banks, which is another check and balance as to how they're selected. They're not even appointed by the president. And they're mostly economists and experts. So my biggest fear about the cycle is the hope that's going to keep it alive is that somehow interest rates are going to plummet. And my fear is that they plummet because the normal independence of the Fed is challenged, and this administration forces them lower, which to me could actually completely backfire and sort of panic the market that the Fed's not independent, but also reignite inflation, which is just really barely under control now. So I guess the framework of my fear is the length of the business cycle, the extenuation of the government spending and the Fed balance sheet, which I truly believe isn't sustainable, and the potential lack of independence of the Fed. I do feel, without being political, that certain of our other institutions are being eroded as we speak. Conflicts of interest, how spending is occurring, how policy is being made. So I do worry about process in government. I don't so much worry about either side being evil and we could go 4 years in one direction, another direction. But I do worry about that there seems to be a breakdown in trust of our institutions, and the current administration is kind of grabbing the wheel and say, well, we know better than those institutions, and that's really not good for markets in the long haul. So I guess I'm constructively bearish. Do I see a bubble? I think several things are very inflated. The stock market generally is very high cyclically in value. Cryptocurrency represents a very large stock of value that is a little hard to explain intrinsically. Commercial real estate, personally, I think is probably the one area of toxic assets I worry about, simply due to the fact that it is a product of interest rates. So there's a lot of loans that come due that have to be refinanced at higher rates. And sort of the pattern of going to the office to work, I'm sure in your industry, it's sort of, there's other remote factors like people in India looking at x-rays and things that, just where people work and sort of where they go to the office has really changed. And we have a huge migration of people from states like California and Texas with high tax structures to places like you live in Miami. And that is not a panacea, but all that change just is going to have winners and losers of sort of where assets are and kind of what they're worth. So I've got my antenna up. I can't say I've adjusted my investment profile, but my mind tells me to adjust my investment profile. You can't pick timing. If you try to get in the market at the bottom and out at the top, you'll always lose money. So if you go back to the Great Liberation Day when Trump announced the tariffs and the market collapsed, if you got out of that market that month, you sort of missed a 25% correction back up. So I'm not suggesting that you can get in and out of the market on timing, but you do want to avoid the bubble things. And so I guess I would. I'm thinking of moderating profile and sort of calling it what it is. Now, having said that, one of the greatest investors of our generation, Warren Buffett, has been stockpiling cash for 15 years. I mean, hundreds of billions of cash in Berkshire Hathaway, and that's been a poor decision. So who knows? Maybe we don't have a business cycle anymore. But I'd say I think we're in the later innings of a correction, and I think I've just touched on some of the factors. Why I think that, and kind of what would trigger a move.
Final question, Craig. What single piece of advice, and you've given like a million pieces of advice during this podcast, but single piece of advice that you would give our listeners who are investing in this time of uncertainty, both in socioeconomic and political?
Well, I don't have a single one, but I guess I have a few. Okay. So the first is diversification. So if you go through time, you frequently hear a concept 60-40 split, and that what means that 60% in bonds and 40% in equities, let's say. And obviously there's things like alternatives and other nuances. Diversification is critical. When the stock market is collapsing because there's a recession, interest rates are falling, so your bond portfolio is going to go up. If there's inflation that's hurting corporations and they're falling, if you own commodities, those will be going up. So what's really key in a portfolio is to have a construction, it's called portfolio construction, where there's diverse sources of generating returns that are not all correlated. So that's like number 1, 2, and 3. And you almost have to work with a professional to know how to do it. The second is avoiding fads. I mean, I think all this social media thing gets you into thinking it's like FOMO, fear of missing out, that you're not involved in NVIDIA. And so there's something about that you have to take into account, because it actually is the source of momentum in price action in securities, but you got to really not overcook it. And I think social media and how people get their information and the crowd behavior. I've never seen more organized because of the way people get their information, and absolutely instantaneous. You in a heartbeat can have a tweet from President Trump, and all of a sudden you're off to the races on something that would, in prior periods, taken months to unfold, and it's instant. And the last one is just taking the risk you can tolerate, and it's both financial, when you have to draw the money you're investing, but emotional, what you can tolerate. And both factors are equally important. People with perfect plans freak out and sell at the wrong time. So I guess those are my sort of really big picture ones. But to go back to the fun side of it, life is fun. We all work to make money, to have a fun life, to support our family, to hopefully leave money to our heirs. So that percentage of fund money is like really important. So if you think of it that way and you have that pot, you can do whatever you want fund-wise. You've just sort of put a constraining factor. And last thing, don't use too much leverage. It's fine when it's working and things are going up. You got to pay the debt back. So I tend to not use leverage in making investments like ever. Obviously, I invest in things where they are using leverage, but I guess for the individual investor, my rule of thumb would be, unless you really have conviction, using leverage is a good path to destruction for a long-term plan. I know it's more than one, but I guess it's a family of
No, it's great.
of philosophies, I guess, that I've tended to follow and have worked for me personally, but I've seen as being sort of time tested.
Craig, what an outstanding interview. As I told you before this podcast, this is kind of a black box for me. I'm not a finance guy, and I do these podcasts so I can learn. And I think the take-home message for our listeners is just the amount of information and knowledge that goes into making these decisions for someone at your level who has been at the highest echelon of finances is really staggering. And the amount of moving parts that need to be taken into account is really, really astonishing. And when you're making investments, whether it's now, whether it's in 5 years, 10 years, I think the biggest point you made was, what is your fund money, right? You don't want to invest money that you need for your home, for your kids' schooling. But if you have money that is extra, that's where you really can have a nest egg. And I think that's a great take-home message for all of our listeners.
Yeah, terrific. I appreciate it.
Well, Craig, you have an awesome weekend. I really appreciate your time. Thank you so much, buddy.
Terrific. Thanks. Great. Take care, and thanks for having me.